Thank you, Brett. That was great. Shifting gears here to insurance. On my left is Tom Gaynor. Delighted to have him talk today about his company and his knowledge of Berkshire Hathaway, which, as many followers like myself know, I mean, he's extremely knowledgeable of the conglomerate. But he comes from a great firm, Markel, which is an insurance company, 13.6 million shares outstanding, trading around $1,400 a share to $20 billion market cap, with traditional and reinsurance insurance businesses. And they also have a substantial investment portfolio, and then they run Markel Ventures, which is an extension of that as well. So please welcome Tom Gaynor today to our Gabelli conference.
Thank you.
Tom, before we talk a little bit about Berkshire Hathaway,
Sure.
I'd like to just talk about your experiences at Markel. I've had a chance to read some of your background and some of your stories, and maybe you could just start off by your initial time working at Markel, how that's morphed into managing all the investments, ventures, and then I think I had read a story about your interest in bringing Markel name and brand to Berkshire, and just talk about kind of that entrepreneurial experience and trying to reach out to investors as well. So.
Sure. Well, again, thank you so much for having me. I see that you've been back to back to back, and the break comes after this. So I appreciate the fact that I'm your last guy before you get a break, and I appreciate your attention and courtesy beforehand. And now you've started with the question I could probably talk all the way through the break with, but I'll try to shorten it as best I can. So my background and kind of the way in which some of these dots got connected was that in 1984, I read the Fortune magazine article by Carol Loomis about Buffett. And that was transformative to me. And I was a kid who had already been interested in investments from a very early age and made all the tragic mistakes in the same path. But that one was like Saul on the road to Damascus. The scales fell from my eyes. I said, oh, that makes every bit of sense in the world. And at that point, I was working for an investment firm in Richmond called Davenport and Company of Virginia. And in fact, just to show you how little I knew about any of this, I remember reading the article and going into the head of the department and saying, hey Joe, have you ever heard of this guy, Warren Buffett? And he said, it was Buffett, you idiot, and threw me out. And but I became aware of it. And that instant really changed the way I thought about things. So I'm at this investment firm, and I'm an analyst and a broker. And in 1986, this company, Markel, that I didn't know, in Richmond, Virginia, was going to go public. And size and scale of things then versus things today, it was 500,000 shares at $8 a share. That was the size of the IPO. And Davenport was a small player. So I got sent out to meet Steve Markel and cover Markel, and I was immediately smitten with the idea that because I had seen the Berkshire structure of an insurance company that specialized and made an underwriting profit, which back in the day was not as common as it is today. I heard, Mary, you were on CNBC this morning, you talked about dusting off your 1970s playbooks, and that's exactly the right thing to take. And that was an era of meaningfully higher interest rates. So insurance companies in general would operate their insurance business at a loss because you had a pool of money, and if you invested that pool of money, and you could buy government securities, I mean, you didn't need to do anything exotic because the interest rates were so high, you could make economic returns, just even if you lost money on insurance. Markel had the discipline of making sure that they made money on insurance. So those are two pretty good barrels in a shotgun. If you make money on the insurance and then you invest the money productively, that is going to push you forward, period, paragraph. So I saw that at Markel from 86 through 90, bought some stock in the IPO, covered the company, wrote reports, became friends with Steve Markel, he became a client, covered the company, and Steve, among his other responsibilities, managed the investments out there. In 1990, Markel did one of their double the size of the company deals, which they've done a couple of over the years, and through a combination of Steve needing somebody to help him out on the investment side since it was getting a lot better, and trying to silence me after I'd been pestering him 4 years for a job, he decided to go ahead and take me on because my dream and vision at that point was, I said, I can be part of building the next Berkshire. and I'm 28 years old, and it's here in Richmond, Virginia, so I don't have to move. And fortunately, my wife Susan, who's here in the audience, was gainfully employed as a chemical engineer at the DuPont company, so I knew I wouldn't starve if it didn't work. So, all the stars lined up, and I joined. And really, from that instant, we started about this process of building it. And one of the things I said to Steve, and this is why I'm just so glad we're back in person and gathering, because I think about all of the things that have happened to me on account of what's gone on in Omaha over the years and just being here. It's immeasurable in a wonderful way. So to Steve, I said, the people who are most likely to understand what we're trying to do are people who already own Berkshire. So rather than try to talk them into coming to Richmond, Virginia, let's go to Omaha and just start meeting people. And that's what we did. The first year, there were 6 people that I knew just from the investment business and whatnot, and we sat down and had coffee and bagels and something to eat and drink, and we just chatted for a couple hours, and we just said, we'll be back next year, and if you know anybody, bring them. And that's grown to where we have a brunch on Sunday morning at 10 o'clock. You were all welcome over at the Marriott. Last time we had it was probably 1,200 people or so in that room. It's just grown organically over the years. There are more shares represented in that room than are represented at our own annual meeting. And by the way, you're welcome to that too. It's in Richmond, Virginia on May 11th. And it should be fun. And we might have 1,000 people there this year, so it's growing. But that's the path. And the formula is epically simple. It's easy to say, hard to do. But have an insurance operation that makes an underwriting profit and invest the underwriting profits with a long-term time horizon and enjoy the compounding that takes place over time. And so the stock was $8 at the start. It's $1,400 today. Every metric that you would look at is compounded at a double-digit rate for that period of time. So far, so good.
So it's a remarkable track record, Tom. Maybe you could talk about, we're here, as you mentioned, to understand some of the lessons of Berkshire, and you've obviously taken a lot away in your time. But talk about your approach to security selection for Markel and the investments, maybe a little bit on the venture side. Your portfolio is a little bit more diversified or bigger than Buffett's, which is more concentrated, and obviously you know about the Apple position. But maybe just talk about where your philosophy aligns,
sure.
Maybe where it might be a little bit different and why.
Yeah, and tactically, just to clarify, so yeah, we have a lot of names, and people, obviously, Buffett's talked about the 20 punches and concentration and all that sort of stuff. If you look at the top 20 names, that's 2/3 of the value of the portfolio. So we have a lot of names because one of the things I like to do, I call them library cards. If I own a little bit of a stock, I will think about it more than if I own nothing of a stock. So I'm willing to buy small positions, mainly because it just stimulates thought for me that otherwise wouldn't be the case. But we do believe in concentrating your bets at high conviction and where you think it matters, so just as that point. Now, to your point about, so tell me about your equity selection and the private companies. The good news is it's the same answer. It's the exact same process. So what we're looking at is businesses and owning businesses like Buffett talks about. It's not stocks and trading instruments, it's ownership interest in business. And what we're looking for in the ownership interest of a business, 4 things. 1, a profitable business that earns good returns on capital and doesn't use too much leverage to do it. That seems so basic, and why do you have to say that? Well, I observe it not being followed so many times, but I want to iterate each and every one of those points. And profitable business. In the media, social, whatever kind of world you want to talk about it these days, sometimes the idea of a business being profitable seems morally offensive to people. That is so wrong. And I think business people are doing a disservice by not speaking up about why making a profit is a good thing. It is an important thing. Thank you. Because here's what a good business does. And we have 20-some thousand people at Markel. And I will tell you, those 20,000-some people, each and every day, turn themselves inside out to help other people, to solve their problems. So every customer we have, the reason we have them as a customer is because we are doing something for them that they want or need. And we're doing it at a price that is a value. So as opposed to them doing it themselves, it's cheaper, better, faster for them to ask us to do it for them. It's an act of service. And it's a dynamic active service that's responsive to what people want or need at any given point in time. So you're fulfilling a high purpose when you are in business to do that. So don't be embarrassed about that, and speak positively about it. And to me, if your business is profitable, well, that means you're doing that, you're fulfilling that, and you're doing it efficiently enough so that there's a profit margin left over for you. You should be paid fairly for the work and the value that you bring. If you're not profitable, well, then either you're doing something that the world doesn't need or want, or you're not very good at it. And in either way, that's not going to be sustainable. So let's just use that as a filter to actually give us an indication and a stamp and a validation that we are serving a social purpose in business. So that's very important, because I want to invest with very long time frames. I can't out-trade people. I can outlast people. So if it's sustainable and it's doing the right thing, that's very important. And the second part of that is not using too much debt. That's recognizing that the world's a volatile place, and things happen that surprise you, that you don't know, you don't see coming. And if you have an interest bill to pay at a given instant that's a bad day, you might not have the staying power to endure through that. So we use some leverage where it is appropriate, especially against fixed assets, but against intangible assets and where there's volatility, I don't want to lever that too much, because I don't want the cards ripped out of my hand while I'm in the middle of playing the hand. So that's very important. Second thing, the management teams with equal measures of talent and integrity. Again, we have 23,000 people, something like that at Markel these days. I'm really glad about that, because that means I don't have to do it all myself. I can't. It's about building a team and having people that are very good at what they do. So, and who do you want to hang out with? So you want people who have integrity, and you want people who are good at what they do. At any dimension you can think of. If you're in a ball club, that's the case. If you're running a business, trying to take care of people, you just want those attributes in people. So we spend a lot of time spending time with people, validating and checking that character aspect to make sure that we trust those people and that they are good at what they do. The third lens is, okay, so say you have a business, say you have great people. Well, that business may be only applicable to a certain size and scale. And that's fine, there's absolutely nothing in the world wrong with that. And we have some businesses within Markel that are very much like that. There's good as anybody, but the addressable market is never going to get any bigger. And those businesses generate cash and do a good job, but that's all it is. A better business is one that can take that money and earn good returns on its capital and know what to do with it and reinvest it and compound it over time. And that's really what the structure of Markel is designed to do, is that if you have a collection of these businesses which are all generating cash to greater or lesser degrees, it's my job to figure out, all right, what are we going to do with the money to keep that compounding going forward? And it's perfect if it's done internally, so I don't even have to get involved. But if not, we'll figure out the reinvestment. And then the fourth and final discipline is valuation, price. You have to pay a reasonable price for that. You don't have to steal it. You don't have to think you get a knockdown, drag-out fight to get something at a real deal. Because if that internal compounding is taking place, every single day that goes by, you're going to look smarter and smarter. And the valuation will overpower any valuation errors you might have made. And again, the unique structure of Markel is because we have a collection of businesses that generate cash consistently, both in the insurance and non-insurance world. We have regular cash flows to keep investing, which frankly enables you to engage in dollar cost averaging, which is the dumb guy's friend. Take every advantage we can get.
Well, thank you on that. So maybe I'll squeeze in to push you a little bit more, but also to bring in the Berkshire angle. We've seen some volatility in the marketplace, and we've seen Buffett put money to work in now Occidental, Chevron, Hewlett-Packard. Maybe we'd like to just maybe get your comment on Allegheny. So two questions there. Where do you see the opportunity for your capital today? Are you following some of Warren's bets? And what do you think about his recent capital allocation? And lastly, maybe some comments on Allegheny.
Yeah, so Allegheny, I think that's a very good deal for Berkshire. Makes all the sense in the world. Allegheny will be able to take the fixed income portfolio that they had to have, because of the size of the premiums relative to the capital base of the company. That's not constrained when you're part of Berkshire. So the ability to reallocate their investments more towards equity as opposed to fixed income is a no-brainer. Allegheny had a reinsurance-heavy mix of business within a big honking balance sheet like Berkshire. That makes all the sense in the world because you can absorb the volatility much more so than you can if you had a smaller balance sheet to work with. So it makes sense from that point. We were long-term Allegheny shareholders ourselves, so have a high degree of respect for those people and that organization. In terms of Buffett's recent moves, I would say they're good and they are of keeping and in the same patterns as what he's been doing for 50, 60, 70, 80 years. He's a thoughtful guy. He goes to work every day. He reads, he talks to people, he listens, he mulls, and takes action when he thinks things make sense to do. And this is no different than it would have been 6 months ago, 6 years ago, 60 years ago. It's the exact same process and methodology practiced by the most master craftsman you've ever seen do it on a daily basis. He's still going at it. As you well know, Berkshire's our largest equity position, so we're rooting for him.
Okay. Before we go out to the clients here with questions, this weekend, obviously very exciting. We're getting the annual meeting tomorrow, 5 hours. Maybe you just give us, what are you looking for in terms of the feedback there? Or is there anything that you expect in terms of corporate changes or anything that could surprise us tomorrow? Or what do you expect from the meeting in general?
I would not expect to be surprised. But I guess that's the definition of surprises. It's something we didn't expect. So I'll be as surprised as you if there's something that you really didn't see coming. It's not the point. It's like going to church on Sunday. It's not that I'm really planning to hear something new, but I really do benefit from being reminded of what I already know. And that's really one of the reasons to come to Berkshire and to renew your sense of the basics and the fundamentals. And these are the things that matter, because being is how we're human beings and we're social creatures. The world and the environment in which you place yourself exerts a gravitational force on your behavior. And I'll give a specific credit to my wife, Susan, again on this in terms of us raising our 3 children. She was very focused and keen on who our kids' friends were. And we didn't just randomly throw them in the pool and see what they came back with. You can't make them like somebody or not like somebody, but you can kind of influence the environment a little bit to frame the choices. And that helped our kids be better kids. Not from what we did, but from who their peers were. So, we're still all big kids. Choose your peers. Choose your heroes. Choose who you hang out with, because it's going to make you better. So the reason I come is not because I'm expecting some brand new insight, but to be reminded of the insights that he's been talking and writing about for decades.
That's good feedback. Do we have any questions from the audience?
Hello. I'll just yell. There we go. I just want to thank you on behalf of the equine industry. You guys are just a great supporter of us. And, if it wasn't for Markel, those horses probably wouldn't be at the Rolex right now in Lexington going over those jumps. And just speaking to that, what are Americans insuring that's interesting, or how are your subsidiaries growing? What other niche markets are you in serving America?
Well, thank you. I appreciate that. And I don't know if anybody else is watching Yellowstone these days. On Netflix. Have you seen the Markel signs? So, yes, yeah, thank you. I would not have watched it except for all these people kept saying to me, hey, cool signs in Yellowstone at the horse shows and whatnot. You actually see some Markel signs. Now here, as someone, and I'm not a horse person. My sister was a horse person. I am not. I had a motorcycle, mainly because I'm lazy. And horses need taking care of every single day. Motorcycles, you put a little gas in it, and when you're done, you just lean them over to the side of the garage, and you can walk away. So she was more diligent than I was. But that signage, I will tell you as fellow Markel shareholders, usually when you're watching a movie or a TV, and you notice somebody drinking a Blanton's whiskey or a Budweiser or wearing a certain kind of clothes or whatnot, those companies paid to get those signs in the shows. It's a form of advertising. It's very effective. It's a good thing. I can report to you, Markel did not pay anything for that sign. That was an example of what those horse shows are really like. And equine insurance is one of the 100 kind of product lines that we would have that would be one of these specialized niche forms of insurance that we would do. So, yes, the equine world is a big one, and it's been around since the beginning of the company almost. Professional liability. We joke where everything from architects to zookeepers. So if you and I think you mentioned some RIAs are in the room, registered investment advisors, some professional liability that you have for that. Some people have called me with gritted teeth about the nature. I think it was maybe Schwab or some of the other, custodial funds that you might work with have had some new requirements in the last 2 or 3 years about the professional liability that you have to have insurance coverages to be part of their platforms. So we would be the providers of insurance through some of the programs and through some of the the broker dealers and whatnot that would provide that sort of coverage. We have that relationship with Haggerty, which is high-end collector cars and boats and sort of affluent lifestyle kind of stuff as one example. We would do vacant industrial properties. We would do cyber is something that we would not have talked about 10 or 20 years ago, but is a new risk and something that people are aware of. And really, anytime you read about anything in the paper or the news or something that's new coming along, especially if it's new. 20 years ago, employment practices liability, where people were suing employers for discrimination or mistreatment or things like that. Well, that didn't really happen 50 years ago, but 30 and 20 years ago, it started to happen. It happened a lot. Well, when those sorts of things happen in society, typically there's an insurance product that comes to respond to that. And Markel would be always open, always flexible, always try to be creative and figure it out. How can we help the customers? How can we take care of them? How can we protect them from that risk? And just like, again, I've already told you more than I know when we're talking about horses. We try to help clients with safety procedures. Hey, if you did this and this and this, if you trained this way and that, and onboarded this way, you might not get sued so much. So that creates a win-win outcome where there are fewer losses and then fewer expenses, so the insurance becomes cheaper. And we really try to not just say, oh, there are losses, so this is what insurance would cost. We take the next step. There are losses. This is what insurance would cost. Now, what can we do to behave differently to make the losses less and lower? Everybody wins when you have that.
Yes, I'm a lifelong television broadcaster, but last week I found myself in San Antonio, Texas, giving a keynote at the opening of the National Association of Independent Sureties. I was there at the invitation of the guy who runs Markel Surety, Mike Kymick.
Right.
And let me just say quickly, you haven't lived until you've spent a day with underwriters and reinsurers. My serious question is whether it's Markel Surety in the business they're in or other businesses that you have big stakes in, where do you see consolidation going? Independent sureties, I see them consolidating, and many other businesses as well. So whether it's that industry or others, can you just give us a high-level view on how you're looking at the continuing pace of consolidation in all industries?
That's a great question. And let me take surety as a specific example, and then we can broaden it out from there. And this is an outcome for Markel from a process that's been going on for decades. So I can't remember exactly how it came to be, but a phone call came in. Somebody called us, and it was the surety business where we had a tiny little surety business, but from Houston, John, I can't remember his last name at the moment because he's retired. He was the one who was there and running that business before Mike. He called us and wanted to come see us because he knew of Markel and he knew how we did business and reputation, and he had started this company, built it up, proud entrepreneur, and he was getting to the point where he wanted to, A, be able to retire, to be paid fairly for his lifetime of work, and C, place his business, i.e. his baby, in the hands of people who would treat it well and respect it and continue to create opportunity for the people that followed him after he left.
So let me tell you, this is a great compliment. I had dinner with John last Tuesday night, and he built a surety business, sold it to people. He did not like what they did with his company and his employees. So after sitting out his non-compete, he rebuilt a new surety company that he sold to you.
Yep.
And to your point, he made damn sure he sold it to the right people, and he told me that he made the right decision this time.
Well, thank you so much. And it's a perfect story, and it's happened many times. And this is what I love about this, is he called us, and he was doing due diligence on us. So he came up to Richmond and spent a day with Richie Witt, my partner, and myself, interviewing us, talking to us, and he sort of looked at us and said, yeah, you guys will be all right. And then he invited us to Houston, and we spent a day with Houston. So home and home. And as we were leaving his office in Houston, we had shook hands on a deal. And then we put it together. And another aspect of the win-win nature of that is, largely Texas and then California were the biggest markets. But he was bootstrapping it and building it bit by bit. Because Markel had an existing footprint all around the country, we can take that surety book that he was building bit by bit and start to offer that product line in all of our other offices and in the existing relationships that we would have, where we're insuring the contractor for the putting on the roof, for architects and whatnot. Well, those people were buying surety coverages, but they were buying them from somebody else. So if they liked Markel and they were buying one form of coverage from us, we could say, hey, would you like some surety with that? It's like the McDonald's drive-thru. You want a hot apple pie with that. You want some fries with that. That surety was something we were able to add on. It's a complete epic win-win-win kind of deal. And the other thing I like about surety is that it requires expertise. You need to know what you are doing. And John would tell you it takes 10 years to train a good surety underwriter. And when you're a good surety underwriter, you are helping your clients because you're sort of checking the plans, checking the budgets, checking the schedules, all that sort of stuff, and making sure it makes sense. And you're monitoring the project, and you're providing third-party verification to whoever it is that's building it, that it is indeed happening and moving along. And if for some reason it goes off the rails, you're the one who helps put Humpty Dumpty back together again to make sure that project gets done. Wonderful people, wonderful business, and to the extent that we can be involved in doing that in forms of insurance or, our Markel Ventures businesses, other ways where we can connect people and put them together and help them build a business. That's Markel. That's what we do. And I think the world is our oyster. There's plenty of opportunity across all kinds of industries for a long time, as far as the eye can see.
Unfortunately, we could talk for a long time more, but I'm just going to finish it up with one final question because I think all of us are here this weekend, reflecting on how we feel about Berkshire and the valuation. And I wanted to just get your last thoughts on fair value here, how you feel about the investment, and then maybe you could just also add in a piece about, giving your vantage point on insurance, rising rates, a harder market, what that means kind of to the insurance component of Berkshire in terms of powering earnings there as well.
Yeah. Well, the good news is that there was some old New Yorker cartoon. I don't know if you remember this, but somebody was saying, the valuation, these two guys, and obviously they were in a brokerage office, but the valuation is that the stock is going up. That's the valuation. So to some degree, my history with Berkshire, that was the very first stock I purchased when I joined Markel in 1990. It was $5,750 a share. I don't remember what the book value was then. I don't remember what the premium volume was, the investment portfolio. I don't know. It didn't matter. What really mattered is there was this guy named Warren Buffett running it who thought about things in a capital allocation sense. And penciling out some numbers, it seemed rough, reasonable. And I would say actually the same thing is true today. And the way I would put pencil to paper and actually do a little math around Berkshire or Markel is I would take the investment portfolio, which some people call the float. Different people define that word differently, but forget that. You can actually just refer to the financial statements. Take the whole investment portfolio, subtract out the debt, and divide that by the number of shares outstanding. That's investment portfolio per share. And if you operate at an underwriting profit and you don't shrink, that money is accrues to the value of the shareholders forever. So it's worth that on a theoretical basis. And then I would take all their non-insurance businesses and look at an EBITDA number, and I would apply a multiple to that, and that gives me a gross number, and divide that by the number of shares outstanding, and say, and that's what the non-insurance businesses are worth, rough range. And I would add those two numbers together, and I would compare it to the stock price, and I would say, is there room? Yes. And will that compound positively going forward? And that's really the more important question, and the answer is, I think so. And certainly history has demonstrated that it has been so far. And I would use that exact same mechanism to review Markel.
Great. Tom, thank you.
Thank you. And I think I think it was John Knox, if I'm remembering his name. Yeah, I don't want to let that go by. Thank you.
We're going to take a 5-minute break, and then we'll return with our final panel. Thank you.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.